All right, let's dive in. Today, we're taking a deep dive into the recent Q1 results for ICICI Lombard's General Insurance. Our mission here is to really cut through the numbers. We want to bring you the sharpest insights from these results and, understand the real story behind them. Okay, kicking us off, we see this really significant net profit jump. It's up 29% year on year in Q1 FY26. But here's the puzzle, right? The gross direct premium income, GDPI, only grew by a pretty modest 0.6%. So a 29% profit jump, but only 0.6% premium growth. That seems interesting. Is that sustainable or maybe just a temporary thing?
Yeah, it's a fascinating contrast. And what's really driving that profit surge, you see, was mostly impressive capital gains. Those gains essentially, they bailed out what was otherwise pretty weak business growth overall. In fact, ICICI Lombard actually lost a bit of market share during this period.
Lost market share, okay.
But there was a clear bright spot, retail health insurance. Even though their market share there is smaller currently, it shows huge future potential, especially when you compare them to competitors. And importantly, the combined ratio, that's basically a key measure of their underwriting profitability.
Right, where over 100% means an underwriting loss before investments kick in.
Exactly. That remains stable at 102.9%, which, in an industry where profitability is generally getting worse, that's actually a positive signal. So just to give you the key numbers, GDPI was rupees 7,735 crore, and the net profit jumped that impressive 29% to rupees 747 crore.
Okay, that brings us to the growth puzzle again. Yeah. You mentioned the industry grew around 8.8%. Based on the recent results, ICICI Lombard's 0.6% looks tiny compared to that. What's going on there?
Well, it's crucial to understand there's a new accounting rule. It came into effect October 2024. That rule is actually moderating the reported growth across the industry. Without it, the industry's GDPI would have actually grown by maybe 12.8%.
Okay, so the gap isn't quite as dramatic, but still pretty big.
It's still significant, yes. Even with that context, ICICI Lombard lagged behind quite a bit in key areas. Take motor insurance. Their growth was just 3.2% versus the industry's 8.7%. And overall health, it was 1.9% for them against 8.1% for the industry. So yeah, they saw weak GDPI growth across pretty much all business segments, except for that really strong retail health performance we mentioned. They even saw a decline, actually, in the group health segment.
Okay, let's unpack those segments a bit more. You mentioned challenges and bright spots. Can we get into the specifics?
Certainly. Motor insurance, as I said, grew slower than the industry. That's likely down to slower vehicle sales generally, plus really intense competition. Though it's worth noting they did maintain their market leadership position there with about a 10.5% share.
Still number one, despite the slower growth.
Got it. Right. Then you have commercial lines performance, which was, frankly, weak. They were hit hard by pricing pressure, particularly in the fire segment. But the genuine bright spot, the real standout, is that retail health insurance business. It absolutely soared, grew by an impressive 32%. Compare that to the industry's 9.4%.
Wow, 32%.
Exactly. And that pushed their market share up in that segment from 2.9% to 3.5%. And the company knows this. They're actively beefing up their distribution network to really capitalize on this opportunity. Just quickly on the product mix. Motor and health shares stayed pretty stable. Fire actually increased its share slightly, and crop, well, that dropped right down to 0%.
Interesting shift. Okay, let's pivot now. Let's talk profitability. What do the underlying financial ratios tell us about the fundamental health of the business?
So the combined ratio, as we mentioned, improved slightly to 102.9%. That was mainly due to lower claims in the quarter. But it still indicates an underwriting loss. They're still paying out more in claims and expenses than they're earning in premiums, technically. However, and this is key, that loss was effectively counterbalanced by their strong investment income.
The investments again.
Precisely. If you break down that combined ratio, the loss ratio, or claims ratio, improved to 73.0%. That's good. But the expense ratio did tick up slightly to 29.9%. On the positive side, though, other indicators look good. Return on equity, ROE, that's how efficiently they use shareholder money, increased to 20.5%. And their solvency ratio, a measure of financial resilience, also improved to 2.70. So quite strong financially.
It really does sound like investment income was crucial here, cushioning those underwriting losses. How exactly did investments perform in Q1?
They performed very well. Investment assets grew by a solid 9% year-on-year, reaching rupees 55,453 crore, and the income from those investments saw a healthy 14% increase. What's really significant, as we touched on, is that capital gains were a major driver. They rose by 34%. We also saw a slight uptick in the realized return on those investment assets, up to 2.3%. So yes, investments were definitely pulling a lot of weight this quarter.
Okay, here's where it gets really interesting then. Despite all this slower growth we've discussed, the analysis based on these Q1 results suggests the company's valuation is, quote, rich but sustainable. That feels like a bit of a contradiction. How do we square that circle? A rich valuation despite slower growth.
Yeah, it does seem paradoxical at first glance. The premium valuation currently around 6.7 times book value, which is definitely high.
Very high, yeah.
It is, but it's seen as sustainable, largely justified by two key factors based on their strategy. First is their superior profitability. ICICI Lombard's combined ratio, looking back at FY25, it was 102.8%. That was significantly better than the industry average. It clearly demonstrates that they're prioritizing profitability over just chasing top-line growth, especially in those really price-sensitive segments like motor and group health. They're willing to let some market share go for better margins.
Profit over volume.
Exactly. And second, that favorable product mix shift we talked about towards retail health insurance, that's absolutely crucial. Why? Because that segment is significantly more profitable. Think loss ratios of maybe 65-70% compared to, say, 94-95% in group health. It's a huge difference. And given ICICI Lombard's relatively small market share in retail health right now, there's what you'd call a long runway for growth there.
Right. Lots of room to expand in a high margin area.
Precisely. And if you look historically, their profit growth has often outpaced the industry significantly, even when premium growth hasn't. So this suggests their consistent focus on profitability is likely to continue being rewarded by the market, hence the sustainable, albeit rich, valuation.
So we've taken quite the journey through ICICI Lombard's Q1 results. We've seen this strategic balancing act between growth and profitability, and definitely highlighted that bright future potentially in retail health. What's your big takeaway here? What's the key insight you want listeners to take from this deep dive into these Q1 results?
I think the core insight really is that ICICI Lombard appears to be very deliberately prioritizing profit over just pure top-line growth. They're making a calculated strategic shift towards these high-margin areas like retail health. Now, this isn't just a short-term reaction. It seems like a conscious move. And while it might be slowing their overall premium growth right now, it looks like they're building a foundation for superior, perhaps more sustainable profitability in the long run. And that's what seems to be justifying that premium valuation.
A strategic pivot towards quality over quantity, perhaps.
That's a good way to put it. And it does raise an important question for you to think about. In this really dynamic world of insurance, how might a company's strategic shift towards more profitable segments, even if it means slower overall growth for a time, actually redefine its long-term value and its standing in the market? And finally, just a reminder for everyone listening, please remember, we are not SEBI-registered financial advisors. If you are considering making any investment decisions based on this or any other information, please do consult with a certified financial advisor first.